Retail spending falls for the first time since March. I'm Lisa Bernhard with Reuters, and I'm joined today by Sam Stovall of CFRA Research. Sam, it may sound like bad news for consumers, but it's good news for markets, good news for the Fed as it looks to slow the economy. What struck you today about the retail sales numbers from the Commerce Department?
Well, I think what really surprised me a bit was the upward revision that we got for the prior month. Instead of it being up 0.2%, it was revised higher by 0.9%. So the consumer is actually doing a much better than the government had given it credit for a month ago. Also, with Wall Street expecting the retail numbers to be down 0.2% this month, but they came in down 0.1, well, that was also a little bit better than expected. So I think that what we're seeing is that the consumer still is out there spending. Maybe they're getting a little bit tired. We had a pretty good holiday season in 2022, so that's a pretty high comparison to eclipse here in 2023.
Tuesday's Consumer Price Index report showed that inflation continues to slow, and we got the wholesale numbers out today, producer price index, that shows that those numbers are slowing as well. So do you think that we continue to decline from here, or any surprises, do you think, on the road ahead in terms of inflation?
Our expectation is that inflation will continue its stair step down to about the 2.2% year-on-year change for the core PCE, the personal consumption expenditure reading that the Fed likes to look at. So between now and this time next year, our feeling is that we will be substantially lower. There could be a month or two in which we end up with flat readings. I don't really expect any backward movements, meaning uptick in inflation along the way, but that certainly is a possibility if these numbers continue to come down quite quickly.
Stocks are rallying today on the back of the retail sales number, and we saw huge gains Tuesday after the Consumer Price Index report inflation data came in. So much talk this year has been about the mega caps carrying the day, but what are you seeing in terms of a broadening of gains in stocks?
Well, we've certainly been seeing a broadening of gains where the mid caps and the small caps are now participating in this advance, which they were not doing in the first year of this new bull market. Traditionally, we have small caps that post a 12-month performance twice that of the S&P 500 early in new bull markets. But this time around, the difference was dramatic. Large caps up 21%, small caps up only about 3%. And I think that was because of the hawkish attitude, approach, monetary policy of the Fed, and causing investors to be concerned that it was going to throw us into recession. But now that the interest rates likely have come to an end, the interest rate hikes, I think investors are saying with the relative price to earnings ratios of small cap stocks being at a 35% discount to their long-term average, now is probably the time to be diving back in.
Let's close by circling back to retail sales, which, even though they dipped down, the consumer is still spending. To your point, the consumer is still largely employed and making a good wage, and we're seeing inflation coming down. And yet we're not seeing the consumer really feel that great about the economy, and their own household sentiment is down. And we saw that out of the recent University of Michigan survey. Biden's disapproval rating went up to 56%, according to a recent Reuters Ipsos poll. Similar polls about the Fed. Consumers have kind of given the Fed a thumbs down. So what is the disconnect? When we're getting good data, why aren't consumers feeling better about the economy?
Well, I think it's because perceptions are sticky, meaning that it takes a long time and a big effort in order for the opinions to change. Yes, we are seeing high prices, but the rate of inflation has been coming down. But most people say, yeah, well, the prices aren't coming down. What they forget, though, is that what is being measured is the year-on-year change, not the fact that we're likely to see deflation where prices go back down again. So that's the one thing. Also, I think we continue to see discord in Washington, D.C., and as a result, everybody tends to get blamed, with the president being, the buck stops here. So the president ends up getting the bulk of that concern. So I would tend to say that unless prices come down, unless stock prices continue to move up dramatically, oil prices recede, et cetera, it's going to take a while, I think, for investors and consumers to believe that they're better off today than they were 4 years ago, which I think will make the upcoming presidential election that much more challenging to predict.